1 2 testing 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 1 2 All right, everybody. I think we're almost ready to get started here. I just got to do a few more checks here with the sound, and then we'll get started. So just give me a couple more, maybe a couple more minutes, and then we'll get started. So just give me a couple, maybe a couple more minutes, and then we'll get started. All right, I think I got rid of the echo there. Okay. All right, so I hope everybody's having a good Memorial Day weekend, and we should be streaming here. I'm just getting this last second set up here, and we'll be good to go here. Okay. So welcome to this webinar. This is going to be a webinar about the S&P 500 and about new services that we have here at Wolftrader Futures. I'm in an expansion mode right now where we're adding many new products and services, and many of you who followed me through the years know that there's always an evolution that goes on with all the work that I do. So what you see now may be different than what you see next month, and certainly what we see right now is different than we've seen in the last couple of months because we have all of these new features coming on to the service. So what I'm going to do today is kind of go through those services and explain to you what's coming on June 1st, because on June 1st we're launching 3 new newsletters, and I'm going to show you the most exciting feature of all, which is the cat graph, the cat master graph, which allows you to get a roadmap of what the markets are going to be doing ahead of time. So that's really exciting because what that means is that before the month even starts, that you have a roadmap. You have something to look at that can give you a general direction to look in. Okay, so that's exciting. All right, so this picture here, I just want to go through these pictures for those of you who like to star watch. Right now we have Venus retrograde, and when planets are retrograde, they're closest to the Earth. So this picture right here was actually a picture of Mercury and Venus. They're conjunct right now. And so if you look up in the western sky, you can see them at night. So this was a picture of them enhanced, looking over. It was towards the northwest, and this was right near sunset. This was another picture here of Venus. I've stretched this picture out so Venus looks a little bit distorted here, but this was also looking out over the west-northwest lake here. So I think it's really interesting to see these planets play out live over the sky and to realize that we are connected with what we see on those astrology maps and those planetary alignments, that they actually are occurring in the physical reality. So I'd like to start out here with a disclaimer. Trading commodity futures involves substantial risk of loss. Past performances are not necessarily indicative of future results. Services include products that are traded on margin and carry a risk of losses. The products may not be suited for all investors. Please ensure that you fully understand the risks involved. Wolftrader Futures is an educational service that is designed to be a supplement to the book A Trader's Guide to Financial Astrology by Larry Pesavento and Shane Smolian. And so those of you who don't know, I'm Shane Smolian. Wolftrader Futures is separate from Mr. Smolian's firm, Trading Ridge Analytics, LLC. The information and strategies presented in Wolftrader Futures are completely independent of any strategies or operations employed by Trading Ridge Analytics. So essentially, just to give you a background here, I'm a registered CPO and CTA with the National Futures Association. So what this is basically stating is I have my own firm called Trading Ridge Analytics, and Wolftrader Futures is completely separate. This is kind of a different endeavor. This is focusing on what I wrote about in the book with Larry. And so the strategies here, they're completely separate. The data used in the creation of astrological planetary data and charts and cycles is public information that is already reflected in the underlying futures prices. So that just means that everybody gets the same prices at the same time. Okay, so one person doesn't get it before the other. So if you sign up for a service, it's, one person's, I'm not going to send it to one group of people before the other. Everybody gets the same thing released at the same time. And I have no knowledge of anybody's portfolios or trading strategies. This is just a newsletter service. So I just wanted to get that out of the way. Now, I do want to start out here by talking about a charity drive that I'm doing. This is for Camilla's House for the Homeless. And so, in this time right now with COVID and what the country's going through, I thought it would be good to do a fundraiser. This is 100% to charity. So this is a shirt. It says "Follow the Fed," and on the back it says Wolftrader Futures. You can see it here. And this is verified charity. So if you go to this site, the Teespring site, it goes directly to the charity. Like I don't even take possession of any funds or profits or anything like that. So it's for a good cause. So go there and pick up a copy of this shirt. Or it comes in 13 different colors. You can get any size you want. It's a pretty cool shirt and it's for a good cause. So this is a little bit about Camilla's House. They do services for the homeless, and so it's a big charity here in Miami, Florida. So if you want to do it, that would be great. I'm going to continue to push this. All the merchandise I'm going to push out, I'm going to donate 100% of the proceeds to charity. So I think this is important, and I think this is just the start. I'm going to also be adding more and more merchandise there. So if you want to do it, it's for a good cause. And like I said, it's certified. 100% goes to the charity. I don't take any possession of any of the profits whatsoever on that. So anyway, so let's get started here talking about my services here. So I've always had the S&P newsletter, and that's once a month, and I give videos a couple times a week on that. And the focus on that is the S&P 500, along with the Fed juice and the cat file. And I put out these videos a couple times a week. But now we're actually expanding out because I've had different people that have signed up for different reasons. Some people sign up for the S&P newsletter just for the astrological commentary and background. So I've surveyed a bunch of people, and the three big categories that people want to have another newsletter on is metals, currencies, and cryptocurrencies. So these are the three big hot categories that you guys have told me that you wanted. So I'm going to focus on these three coming up on June the 1st. So if you go over to the website now, you can sign up for the S&P now, but these next three are going to be available on June the 1st. So that's only about a week away. So, and I'm going to give you a background into what you can expect into seeing these newsletters. So the metals newsletter has 4 symbols. It's going to be copper, gold, silver, and platinum. And the currencies has a few more. We have the US dollar, the Canadian dollar, the euro, the British pound, Japanese yen, and the Australian dollar. And the cryptocurrencies have Bitcoin, Ethereum, Ripple, and Litecoin. And those pretty much track each other closely, but there are some differences in those cryptocurrencies. And I'm going to show you how they track, how Bitcoin has tracked in the last month shortly here. So, all right, so I'm going to start out with my focus here on the S&P 500, just to kind of give you an informative background in terms of what's going on and how I see the market right now. We're still relatively at a neutral level. So even though the S&P has done all of this rallying up, it's nowhere near an extreme value. So this is still surprisingly bullish on the S&P 500. So we see here 50%. It's just right in the middle. It's neutral. It was more bullish in the last couple of weeks and months, obviously, with the negative sentiment of the COVID crash that we saw. But this is still looking relatively bullish. So um, that's good for the market. So I like to check back with this indicator. You guys can check it out yourself. It's on CNN, and they have a graph over time, so you can see here that we're kind of just right there in that middle level. These are previous levels that it has gone to. So when we got right to that peak right there in January, we were at these extreme sentiment levels, and it went all the way down to these record levels down into here. And this was right at these lows here. Now this is right when the Fed started QE4, and I'll show you that on another chart in a minute. But this was the extreme level, so we're nowhere near an overly, you know, bullish sentiment on this market. So there's still plenty of room for this indicator to move up on the markets. And now we have, like I said, we have such a powerful Fed moving in here that even if it does start heading up into these levels, that there's just so much energy coming from the Fed that it's going to be hard for this market to go down. So that's not to say that there aren't negative forces out there, cycles and astrology forces. We do have a bumpy ride from the astrological standpoint from now, probably now through December. It's pretty bumpy. And then next year, we still have to deal with quite a bit. These COVID global transits. I identified one of them. They're coming back in August, the shutdown, and then it's coming back in late November, and then next year we still have a lot of plenty of planetary issues with the disease on the world, and then there's still a lot. So the point is, what I'm trying to say is that the Fed is strong, but there is still some negative astro cycles out there that we have to overcome. So what we're looking at is essentially a tug of war. And so my job for you guys is to try to help you understand who is winning that tug of war. Currently the Fed is, and that's not really that big of a surprise. But that's not to say that if the Fed lets their guard down, you know, bad things can't happen. It's possible. So just want to put that out there. Now, this here, and by the way, I'm going to do a little bit of a longer presentation than I normally do when I go on Larry's show or radio show, because when I go on these radio shows, it's kind of a rushed thing and I have just a few minutes to talk. So this is really an extensive, in-depth view of the markets and how I'm looking at them. So, so we're going to go in detail today. All right, so this is this is a heat map of the CME. So this is the open interest of the S&P, and I really like to go here because it gives me an idea of what the investors are thinking. So we just saw that on that fear and greed index that it was right at 50%, right? But what we see on the CME is we see that it's actually, that's not really telling the whole tale of the tape. You have more people here buying puts than calls. Okay, so in other words, this is decidedly more bullish, even more than the 50%. When I look at this, when I see a lot of people are betting on this market to fall, that's a good sign from a sentiment standpoint. That you want to, from a bullish standpoint, you want to see people loading up on one side of the trade, and these investors are loading up on the put side. So that's important. You guys can go there and most of the stuff that I'm posting, you can go check it out yourself. So like the CNN fear and greed, you can go see that yourself. And this open interest, you can go on the CME. They have the heat map there, but this is really important stuff to look at. It shows you the open interest also. Now, the open interest, a lot of traders swear by that, and through the years, it has meant a lot because commodities are based on a very specific supply and demand. But with the Fed and the S&P, the Fed can actually do more work when the open interest is falling. So it's not so important on the S&P anymore, the open interest, because when you have lighter volume, the Fed can get to work more with the Fed juice. So just pointing that out. This one is interesting too. This is the open interest percent change. So what you see here is that you see huge changes here in people betting that the market's going to go down on the put side. So that is that is just so it's so bullish to me when I see these people just betting that we're going to fall. And even if you look, these are days out. So again, you can go to the CME and find this, and you can email me. I'll try to I'll put the link in below on this after the webinar is over. But on multiple time frames, you can see that people are just loading up on these puts on 11 days out, 18 days out, 25 days out. I mean, everybody still thinks that we're going to go crash and go south on this. So from a contrary standpoint, that is really, really bullish. So, when I look at sentiment, I like to look at the CNN one, but this is really the one that's telling you what the people are doing in terms of their short-term interests. So again, we want to be looking at the opposite of this. So if we see so much movement on one side of the trade, there's a good indication that's going to go the other way. Okay, because most of the time people are wrong on these bets, and that's just how it works. It's a same classical case of psychology, that when you have psychology, the way that psychoanalysis works is you have the conscious mind and you have the unconscious mind, right? And so the whole point of the unconscious mind is to compensate consciousness. So when the consciousness becomes too one-sided in its attitude, to bring it back to equilibrium, the unconscious comes in and compensates it by doing the exact opposite. So if more people are bullish and bullish and bullish and bullish and bullish, and you hear people saying, well, why aren't you doing this? Everybody's doing it. Everybody's buying it. And you start to hear that, that's a one-sided conscious attitude. And then what happens is it compensates and goes back to bring us back to equilibrium. So this is why when you have these sudden reversals, it's often a surprise because everybody gets caught up in it's the herding instinct of humans. Everybody gets caught up in this one-sided trade, and then we get compensated back to equilibrium. So that's the idea behind that sentiment, and it goes way back into psychoanalysis of the early 1900s with Carl Jung and Sigmund Freud. So anyway, okay, so this is a view here of the new color scheme. So I'm expanding these symbols out. So we're almost up to 20 symbols now. So one of the things is when you get these charts each month, so you can understand what you're looking at, the charts are each going to have a different color. Okay, so I think that's really important because when you're scrolling through charts, particularly if you're on Twitter and you're looking and looking and looking through charts, I may post up to 60 charts a day on Twitter. I mean, it's just a constant information feed. You can quickly look for the color of the symbol you're interested in and you can find it. So copper is this bronze color, silver is kind of grayish, gold is yellow, platinum is this light purple color, corn is orange, natural gas light green, oil dark green, British pound blue, like an off blue, euro is always aqua, the bond is pink, S&P 500 is white, Canadian dollar is light pink, Japanese yen is fuchsia, US dollar is dark green, appropriate color, right, for the dollar. Australian dollar is dark blue. Bitcoin is like this teal blue. Ethereum is going to be like a red. Ripple is going to be a burnt orange. And Litecoin is going to be like a light lavender color. So it's important because when you look at these charts, you can immediately know what you're looking at. It's not just that you're just looking at some chart. You're looking at the actual color that goes with it. So one of the new things that we're doing here is I'm actually identifying statistical advantages based on the week and also the day of the week too. So what you see here is this is for like copper, silver, and gold, okay? And then this is by the week of the month. So I color code these also. So it's kind of like the colors of the rainbow as you're going down, red, orange, yellow, green, blue. So the idea is that it ranks them from 1 to 5 based on the highest probability. So percent up means that what is the probability? What's the highest week that it's up? Okay, so the number 1 means that this week statistically, it doesn't mean that this always happens, but it means statistically this is the highest probability that copper is up, right? And then 5 is the lowest probability that it's up. So that and then you can read, this is also a heat map. So if you want to say, well, when is silver up? Well, it's up last week. Okay, this was last week, and that's the highest probability. It's also still highly probable for the week coming up here. But this is a really cool way that you can understand based off of the history and the statistics, hey, look, these are supposed to be strong weeks into here, you know, and we know that silver and gold and platinum did reverse last week. They went up to those highs and they kind of came off, but um, it's still relatively strong this week too. So these are really important. I mean, I found them to be very useful. And when you sign up for the newsletter, you'll also get the daily statistics. Like I'll tell you, you know, Monday and Tuesday are the most, you know, statistically powerful days for this symbol, and you know, Friday and Thursday are the weakest, or whatever it is. The next column here that you see is the percent reversal. And what this means is that what are the chances that it's going to do a reversal from the previous week? So, you know, this week here says that this is the highest week that it's a reversal. So, for example, if this, like, this is a perfect example here. So this is the weakest. So let's say that that week that copper goes down, it falls that week, right? And so you say, well, this week is coming up. This is the strongest percent chance and the strongest chance that copper is going to reverse. So most likely copper is going to want to do this the next week. Okay, so this has nothing to, this is not astrological based. This is not Fed based. This is just statistics. So I'm working heavily to create a balance with what we're doing. And so, and by putting all these together, I get the new cat file, which some of you may have seen. So you'll be getting this with the newsletter, and you know, I'm going to give you all the different building blocks. This is a building block, okay? So the statistics and the probabilities are just a building block, and then we're gonna put those together in the cat file. So if you're not really interested in the building blocks, you can always just defer to the cat files. So just something to consider there. Now, let's get into our S&P 500 here. So S&P is in a very bullish mode right now from the Fed use, and I'm not looking at sentiment. I mean, when I tell you that, this is based upon what I look at with the Fed. I have multiple arrows here, so it might be a little confusing, but you can see there's a whole bunch of them that are bullish now on this S&P, and that's good. That's good news for the market. And we did have this pullback into here, and that did this abrupt U-turn into here and went right back up that last Monday, and it just acted as if none of this happened. You see that it just kind of went up, and it just, oh, that didn't happen, and it just keep going like this. And I think ultimately that's what will happen here. I think this will just kind of go up and, you know, pretend like nothing happened with the S&P. It's only because of the Fed. I mean, clearly these are not natural market patterns. I mean, the markets don't do this, particularly when the economy is shut down. But anyway, so last week, the previous on the around the 17th, around there, and 18th, this point right here is a very significant point in the markets, because this is when the Fed began the corporate credit facilities. And what it is that's a new type of QE. It's a direct purchase of ETFs. So, you know, the Fed use that I measure, it's multiple operations, but those usually take a few days to get a hold of the markets. It appears that this ETF, the effects when they purchase these, it's immediate. It's like an immediate effect on the markets. And that halted any downtrend we had, and it just U-turned right back up and went right back into a buy. So one of the things to understand is that the Fed is unrolling all of these new tools, and they have to do that because the banks don't always comply with what they want them to do. You know, they have to have this repo market, this reverse repo market. They have these new credit facilities coming out for corporate credit facilities, and then they have the Main Street lending, which is coming out in June, and all of those are bullish signs on the market. So we need to look at the market in the context of that. So, for example, if the Fed, let's just say, is putting an upward force, let's just give this a number like 10, let's just say, on the market, right? And we know that there's negative forces out there, that you know, there's COVID, and let's say there's negative transits on the markets. Let's say these all turn down, and those are giving us a downward force of 7. We have to look at this as if it was a type of a spread. Okay, so those of you who trade, you know, credit and debit spreads understand what I'm talking about, that we still have a net positive of 3 if you subtract these two out, right? So that's how we have to look at this. We have to look at the balance between the Fed and the cycles, and essentially what's happening is we're still getting this chug higher on this market. So, you know, and that's my job, and that's what I do for you guys, is I help you understand, you know, what is going on between the Fed and the cycles. And so a lot of people just want to take the Fed out of the equation and just pretend like that's not, like that's not happening. No, 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 no. That's just not, that's not, you know. And so it's not wise to do that. And I'll tell you from my experience, because I tried that for years. I tried just to look at the cycles and the astro, and I swore by. And there were some times where I could pick, and I'll send these statistics out. I used to trade the Nasdaq. Those of you who started trading with me, it was right around 2007, 2008. We were able to pick the turns on the Nasdaq based just off the astro, just off the transits, and it was like the trades were incredible. It was like, I forgot what it was. It was like 25 out of 28 winning trades. It was something ridiculous. And then the Fed came in and it just stopped working, just like that. I mean, it just stopped working. And I couldn't figure out, like, what is going on here. And this happened again and again. And then during periods of QE, after the Fed started in 2009, there were periods like during the 2011 summer meltdown, which I forecasted. It followed the astro beautifully, right? Because the Fed had stopped. But then later on that fall, the LTRO started with Europe and the astro stopped working again. So what I have found is that if you want to understand what's going on, it's not that the astro stopped working, it's that you have to look at them together. How are they working in harmony together? How is the Fed working with the astro? And then you can understand what's going on. Now the market makes complete sense. I mean, every time that the Fed lines up with this planetary speed index, you get these beautiful moves. Okay. I mean, except for that last hookup last week, which again, that was the corporate credit facility. The Fed is directly buying the markets. Now they're buying ETFs. Across time, if you align that together, you'll get, outcomes that make sense. So I'll give you an example here. And I told you guys this is a much more detailed webinar than I would normally do on a radio show. So um, bear with me if there's something else you want to see here going forward. But I have to take the time to explain this. So what I have down here is I have the Fed juice, and this is an indicator that I've developed across time. And I measure all these different Fed operations that go on, and then I created an indicator that reflects that information back and forth between the S&P 500. So it's telling me relative to what the Fed is doing, how strong is the market doing? So it's a relative indicator, and it reflects back and forth to me. Okay, the market is responding well, it's not responding well, the market's responding. And so when it tends to go into these sell periods, the market can tend to have these sell-offs, okay, when this happens. So this is a signal that has to be re-educated, okay? So now I have it once every month, okay? So once every month it's going to be re-educated because the market conditions change, but it is directly going off of what the Fed is doing. So the last time before we came into this sell-off, it went into this sell on February the 21st, okay? And the market started falling. Now, the planetary speed index, you can't see it here. It was in black over here, but that was also in a sell. So when I talk about an advantage, I'm looking for the tape and the cycle, okay? So the tape is the Fed juice. In other words, I want to put two things together, and the cycle is going to be the planetary speed index. So it's kind of like in the military, like when you have people down in the missile silo, you want two people to turn the key at the same time to launch the missile, right? That's the whole point of the fail-safe, right? So I have a fail-safe with the S&P. I have to have the Fed juice, turning the key, and I have to have the planetary speed index turning the key. Then the market starts to move in that direction. And it's like I said, it's making sense of this together in harmony. So when these two are together, you get these ease of movements down. So this is let me show you here. Hopefully this shows up. So right here, this line here was when the last time they were lined up here. You see that? So that was an ease of movement there. Now, you see they're not lined up anymore. This is down and this is up. So they're in conflict, okay? So there's no signal. Then they come into harmony again here on the 12th because the planetary speed index was in a sell there, right? So again, planetary speed index turns the key, Fed juice turns the key. There you go. Here's your movement right here. You see that? There's your movement. Then, now, this is one thing too I want you to understand. Right here, this market over here has nothing to do with this market over here because you had QE4 here and you had $80 billion a day of purchases. I mean, the Fed was going nuclear. They were on pace to do in 1 month what all of QE1 did in the whole period. Now they've calmed that down a little bit, but this is, you have to understand that this is not a natural market what you're looking at. And if you try to use regular cycles and extensions and time, all of these different ways that you can measure, you're going to have trouble with it because it's not going to make sense. There's no reason why this market should have bottomed here without the Fed. Okay, so then the Fed comes in. So let me clear this out. Fed comes in here, QE4. Didn't take them long to turn it, did it? Got 1, 2, 3, 4, 5. Wait, 1, 2, 1, 2, 3, 4, 5, 6 days. 6 days. They turned it. That's all it took them. 6 days. Okay. This market should have been going down and down and down and down, given the situation of COVID and everything, but it didn't. Okay. Why didn't it do that? Because the Fed was in there. Okay. That's why. I mean, it's so obvious. I mean, I will show you by the Fed data, the raw Fed data. This isn't raw here. This is my signal. It's so obvious what's going on. So if you say to yourself, well, the only thing that matters is the close and the price and the volume, and I'm just going to pay attention to that, and everything else is just it. Maybe in the past that could have, that had more of an argument, but now when you have this huge Fed into here that can purchase 80 $80 billion a day, they're such a huge player into this that, and when they can just turn this at their will. Okay, so the next advantage came here on the 22nd. Now that's when the planetary speed index went into a buy, and this is when the Fed juice went into a buy. So there you go. There's your first key, there's your second key, okay? There you go. So here's your advantage up to here. Notice it turned up at the very last second. And then, this went out of phase and so on. So this one went more or less sideways this time. But the idea is that you want to align the Fed with the planetary speed index. So that's the idea. And I just want to kind of give you the backdrop of that. Now, this last time you can see it went into a sell and it just hooked right back up. I mean, it just had no regard whatsoever for that Fed, even that Fed, just because, and the reason is, like I said, you have these billions or millions and millions of dollars now coming into these ETFs. I'm going to show you on a graph. I'm going to show you the graph just so you can see. I'm going to show you the raw Fed data, and I'm going to show you the corporate credit facilities, the bonds, the junk bonds. They're inverting again. In other words, they're going into a bullish profile. And you can see the exact day when the Fed said we're gonna come in and stimulate this market, and then you can see the exact day when they bought the corporate bonds, and you can see the bonds just start going straight up. Okay, so the Fed has more and more tools at their disposal now. And again, a lot of people are focused on like gold, like they may be like market purists, like I believe in the gold standard. Well, I don't believe in that, and let me tell you why. We're dealing with a system that's a complex system now. The global economy is very complicated, and if you look in nature, the most complicated biological systems operate on something called a negative feedback loop. Your body operates on a negative feedback loop. Every organism operates on negative feedback loops. And all negative feedback loops do is they say that you want to be in a state of homeostasis, okay? Your body wants to stay in a state. So that homeostasis could be, you want to keep a certain heart rate, you want to keep a certain breathing rate. And or if you need more oxygen, so let's say that your oxygen level is dropping, okay, or you need more oxygen, let's just say, your body will start to increase its heart rate to try to get you back to homeostasis. If you get too hot, your body will start to sweat and it'll start to come back to homeostasis. This is how the thermostat in your house works. If it gets too cold, the thermostat shuts off. If it gets too hot, the air conditioner turns on. So the most complicated biological systems operate off of this thing called a negative feedback loop. So essentially what the Fed is doing is they're just trying to keep some type of normalcy in the markets. They're trying to keep liquidity. So the Fed gets demonized and demonized and demonized. But the reality is that if you didn't have the Fed in 2009, we would have gone into a depression and the banks were shut down. And, a lot of people like to make these arguments and say, well, let it fail. Let us all fail. And I'm thinking to myself, is that really what you want? You really want the banking system to shut down? You really want everything to fail? I don't think so. So, I feel that these operations are important. Now, the problem is that the banks don't always follow what the Fed does. So like the Fed may start cutting rates or the bonds may rise, or so the Fed may have to come in and do repos, right, to keep lending going. Or if the Fed wants the banks to raise interest rates, like, and this happened when Powell first came into office. So that first panic that we saw back in 2018, That was kind of caused by the Fed because they started with these reverse repos. And so for example, if you want, let's say that, the bank's offering 3%, which they weren't offering. Let's just say they're offering. And the Fed's like, I want you to offer more. Okay. I'm going to start raising interest rates and you need to give these savers more money. And the banks are like, no, we don't want to raise our interest rates. So the Fed's like, well, I raised my Fed funds rate. And the bank's like, no, we're not going to raise our interest rates. So the Fed's like, okay, I'll tell you what, I'm going to give people a better return for their money. I'm going to do it at 4% or something like that. I mean, this is just an example, but this is like a reverse repo. So the Fed can start to pressure the banks to raise interest rates or to lower interest rates. They can do it in all these different ways. Right now, what we have is we have something going on where they need to increase the liquidity and keep their interest rates low. And so the banks may not want to lend. So the Fed is coming in with all of this help with the corporations, probably with mortgages, probably with auto loans. They'll be coming in. So the main street is going to be starting in June. So there's even more coming in. So the Fed is directly acting in the interest of the consumer and in the interest of Main Street. So one of the biggest criticisms of quantitative easing was that it helped the market, but it didn't help Main Street. So this time, I think what Jerome Powell is trying to do is he's trying to get that liquidity going on many different levels, and I think they're doing a good job of it. I mean, you may disagree, but I think this is important. To me, all of this makes sense what they're doing. Okay, this all makes sense to me. In the complex global uh, economic system that we're in, I think it's important to be able to print your own money, and I think it's important to have a strong central bank. That's my opinion. Some people are very focused on gold and gold standard, but hey, look, we're in a different age now. And I think that considering what we're looking at, I think it's a pretty good solution to what we have to deal with here. Okay. Because we're able to adjust quickly, like to crises like this, the Fed was able to adjust. Okay. So that's just my take on that. But we're going to continue on here. Now, all right. So you'll see here that on this chart, there's also these purple arrows. This is called the cat master signal, which I'm going to get into here. This is a new, and I will call it very important development in what we've been doing. And this stands for this stands for, cycles and transits. And what this does is this combines multiple systems into one indicator. So it combines multiple astro systems into one indicator here. So um, you can see here on the 7th it was a buy, the 12th it was a sell, the 17th it was a buy, and it doesn't go into a sell until the 29th or June the 1st, somewhere into there. So this is still bullish here on this time frame too. So let's keep going here. This was a 1-day chart. Now I had put this out a few days before. We're actually rallying now into this. So I do expect this market to be relatively bullish, at least until June the 1st. Now I do tell everybody I like to take this 1 week at a time. Um, I don't think it's wise to go more than 1 week at a time, maybe 2 weeks. I do notice some, like I'll star an event out into the future. I'll be like, okay, like, this date out in August looks bad here or in October here. But really, I think it's best just to focus on 1 week at a time. And so right now we're still relatively in this bullish profile on the S&P 500. So yeah. Um, yeah, so these are just the levels could go up, and the Fed use is still in a buy down there. All right, so this is the daily, some of the raw Fed use data. So this is not the master Fed use signal, but you can just see the steady rise of the Fed use across time. And even when the market was falling into here, this was during the COVID decline into here, that you just had a consistent rise from the Fed, and they were really supportive and accommodative of this market. So eventually it turned the market. Now, it's very tempting to think that this Fed indicator is just some kind of a moving average of the markets. If you go back and look through time, the markets pretty much follow this pattern. But eventually the markets did catch up to what the Fed was doing. And again, this is what I look at when I want to understand what's going on with the markets and what's driving the markets. So the QE was announced here, and then the unlimited QE was announced here. And this is what allowed them to do 70 to $80 billion a day in this market. So huge. All right, so this is down here. This is the S&P when priced in terms of the Fed use. So instead of being priced in terms of dollars, like this chart is priced in terms of dollars, this is priced in terms of Fed use. So you can see that we're still at very low levels down into here. And so that's still bullish for the market going forward. So when I like to see that, when I see the price coming down like that, that that's when when I see it at those low levels, that's a very bullish sign. Excuse me one second, I'm just looking something up here. Trying to look up the recent Fed purchases here. Yeah, so yeah, they've tapered down a bit. They're down to probably 20 billion, but they were up to like 80 billion or something ridiculous in a day. But the point is that this is coming off lows. So every time it comes down into these lows like this, it tends to have these extended rallies. So it's not surprising to me that this is occurring from this perspective. Now, again, I'm not taking into account COVID or what's going on with the virus right now. I'm just reading the charts based off of the Fed, and to me, that's the only thing that has made sense across time. If you have to kind of understand what the Fed is doing, otherwise, it's not going to make sense. Like I said, there's no reason this market should be rallying right now without the Fed use into there. This is the one. Now, this is the one I was telling you about. Okay, so pay close attention to this chart. Now, this is something that I normally just put for the gold members, but I'm putting it out here on this webinar. So pay close attention to this. This is important. Okay, so this is a spread here between, this is the TLT. This is a 20-year ETF. Now, this is really some kind of a hybrid between the 10 and the 30-year the bond, but they made an ETF. Okay, but the point is that this represents the quality. Okay, and this represents the junk. This is the high yield stuff of the corporations here. Okay, so what does that mean? Why does that even matter to markets? Well, what happens is if you look back here, this is right in late January. This is right when the Wuhan COVID-19 was getting out of control, when they were building the hospital. Remember, they built that hospital in like a week and everything was getting out of control. The market started getting wind of this ahead of time. So when this inverts and this heads above this average here like this, you see this? That tends to be very bearish for equities. Okay, so equities tend to fall when that spread goes towards the quality. Okay, so this represents the velocity of money leaving the junk bonds and going into the quality bonds. Okay, which in this case I'm using the TLT to represent. So why should we care about that? Well, the point is that when you have this going on, you have a lack of liquidity in the corporate markets into here. You see these bubbles into here. This means that the markets are freezing up. Okay, the credit markets are freezing up into here. So that's important because corporations can become insolvent when this happens. So you don't want to see these huge spreads like this. So even if the market's going down, you don't want to see this happening. So what happened is the Fed comes in here and they said, we're going to start buying junk bonds. Okay, so immediately that this junk bond market gapped up here. Okay, and this started to move down, but then it kind of jogged back up, right? And now they actually started this. This is the corporate credit facility into here. So this is what I was talking about into here. This is when the Fed launches the corporate credit facility. So what I'm trying to tell you is that this stuff is directly reflected in the markets. It's not just, they're buying the markets, they're buying the ETFs. So, at this point, they maybe made the pledge to buy it, and this is when they started buying it. And so you see here how it starts jogging. There it goes. It starts going up there, right? And now on Friday, you see this first bullish cross lower. So why is that important? Well, that's really important for Main Street and for the corporate credits, because now you're going to start to have liquidity, and that's important for the economy. It's important for jobs. It's important for everybody. Okay, so the Fed is going directly to. They're saying to the banks, look, banks, we're going to help you, but if you're not going to lend, we're going to go do it ourselves. Okay, and that's what they're doing right here. So, and I think it's great. I mean, this is really important for the economy. I mean, we're in a critical time right now. The global economy is shut down, and this is really, really important. So, yeah. So that's what this represents. So what I'm telling you here is when this occurred here, that you go back to the S&P. When I was trying to tell people this, okay, you go back to that S&P. That's what this bottom was into here. You see this right here? That's what this was. So, this is all related. I mean, this is, if you looked at the intraday chart of that day when that reversed, it was going down, 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 down. And it was like the hand of God comes in, right? And it just starts going like this, like this, like this, like this, like this, right? That's not a natural pattern, right? There's nothing natural about that. It's the Fed. Okay. So, you know, there's two ways you can look at that. It was three ways. You can curse the Fed and say, oh, that Fed, I can't believe that. You can say that the Fed has no effect, or you can look at this chart and you can say, oh, yeah, the Fed does. Oh, yeah, look, the Fed does have an effect, obviously. Okay. Or you can look at this chart and you can say, oh, obviously, the Fed has an effect. We can see their operations going on. So I choose to take the perspective of, hey, look, they're trying to increase liquidity, and we can take advantage of this with the forecast, and we can track this across time, and we can use this to our advantage. I mean, I'm just neutral on it. It's just like it is what it is, man. This is what the Fed is doing. Okay, so uh, and again, I think positive. So this is the weekly. So I've said this from the beginning. It's still a bull market. I've never changed my stance on that. I actually put out a tweet on March the 20th, and I put that in the newsletter. So for those of you who don't remember what March the 20th was, this was in here. This was right around these lows, and this is March 22nd, like right around here. I said very clearly, I have full faith that we'll turn this around. And it's true. I mean, we will turn it around. We do have the brightest and smartest men and women working on these solutions, and we will figure this out. And I have full faith in the Fed. I have full faith that they're going to support these markets. Okay, look at what they're doing on this weekly time frame. Okay, yes, we might have jogs up and down into here that last a week or two at a time. It's true, but over time, okay, that this is a very, very positive picture, and I'm very happy to see this because I've seen times, for example, when Jerome Powell first came into office, we've seen times here that this is his whole reverse repo thing into here, where he was trying to force everybody to raise their rates, through the reverse repos. And I think he understands now what what has to happen for these markets, the liquidity that has to occur here. So if I saw the Fed use if I saw the Fed use jogging down like this right now, I'd be a lot more worried. But I'm not worried because look at what it's doing. It's going straight up. It's just a very consistent roll higher, and we also have, like I said, we have these other operations popping up, like the corporate credit facilities, the Main Street lending. There's just so many tools that they have now, which again I think are essential to helping the economy. This stuff is very important. I mean, like I said, there are purists that believe that gold is the best way, but I just think this is a way that you can respond very quickly to what's going on. If you're very vigilant and if you understand where these liquidity pockets are occurring, you can target them specifically. Okay, so this is the S&P. So I think we're getting a lot closer to this 786 level or 78.6 level into here. And I think there's a good chance we'll be getting back up there pretty soon. We do have a short-term high on June the 1st, which I will address when we get there for the subscribers. Like I said, I like to take this, 1 week at a time, but we're getting pretty close to that. And I think if we get up to that 78% level, I think people are going to start to panic because there's a big fear of missing out that people have. And I think if we get that high, then, you know, it's going to be very bullish going forward. You have all of these there's many tech companies that are making all-time highs. The S&P, the Nasdaq's, pushing near all-time highs. So the S&P is not that far away. So, I mean, I just, short term, we could have it could be bumpy at times, but long term, I feel pretty good about this. Okay. So is there a chance the Fed could fail? Yeah. I mean, why not? I mean, they could fail, but I have never seen them fail. Since 2009, I've never seen this fail. Okay. I've never once seen this fail. So if it's going to fail, I haven't seen it happen. And again, they can increase their liquidity by an order of magnitude overnight. We saw that if you're doing $80 billion a day, that's huge. I mean, it's massive. So this is a very powerful tool. that you can use, to understand the S&P. And again, what I'm trying to get here is I'm trying to educate people on what is really going on here. Why is the market acting like this? Why isn't it going down when it's supposed to be going down? So this is why. I mean, and if you took away this Fed juice, the S&P would be much lower. And this is why I priced the S&P in terms of the Fed juice, but it's not going away anytime soon. So this is a relative strength that I like to look at, and this is one of the things I was also arguing against when we were declining. When you see a market that is declining, it's like a full crash mode. If you really, really have a crash, okay, like this happened in 2008, the fall during the Lehman, that the relative strength of your leading tech indicators and your leading bellwethers will be much weaker than the S&P 500, okay? So what did we see during the decline here? Well, here's our decline here. This is the COVID here. This is when it started. Okay. We started out here. This was Wuhan out here. Okay. Wuhan. You can't read that. Okay, that's China. So, okay, Google fell down with it, but it fell at a much slower rate. So the relative strength of Google was actually strong compared to the S&P. So when you see a market that's really crashing, you're going to see the tech lead to the downside. You're going to see the strong stocks lead to the downside. You're not going to see Google outperform the S&P when it's falling, and that's what we saw. So now it's still relatively strong. I mean, there's nothing here that's telling me that Google's starting to tank relative to the S&P. It still looks pretty good. So I don't really see anything here that makes me say, oh my God, look, Google and Apple and the bellwethers are starting to crash. They're not. Okay, they're not. They're relatively strong. Now, there is one sector here, which I'll get to, that is weak, and that's the banks. The banks, and I really think this is why the Fed is starting up with these credit facilities. The banking index is very weak right now, and that is the only chart that I've looked at that really looks troubling for the market. And so there's many reasons for this. It could be liquidity issues. It could be they don't want to do the PPP loans. They don't want to deal with all of this. Who knows what it is? But we do know that this particular sector is weak, okay? And when the Feds announced the QE, they did cross back up and get strong, but this one is weak. So I would say that this is something that we need to watch for sure. But as long as you have the central bank that can come in and back these and come in with the corporate credit and come in with the Main Street, I think you have a backstop on this. But this is still something to watch. I mean, I will admit to you that this is not a good looking chart for sure. But we'll see how this plays out. We'll see how this plays out. Right now, the S&P is holding up pretty good. All right, so those of you who are new here, let's talk about the Planetary Speed Index. So the Planetary Speed Index, so some of you have seen this before, but essentially this is my tape measure for the S&P. This is the astrological basis. So this is the planetary, this stands for Planetary Speed Index raw data. It's a high resolution look at the speeds of the planets, and this is including multiple planets, asteroids, and also trans-Neptunian points used by Uranian astrologers. It doesn't work unless you include the trans-Neptunian points. So this is a 1987 crash, and so you'll find that without exception, that the red here is the Planetary Speed Index here. That's what this is. This is the Planetary Speed Index here raw. That the markets always have their biggest crashes when the Planetary Speed Index is falling. So there's no exceptions to this. Okay, so these curves have nothing to do with each other. So in other words, like I'm not deriving the red curve from the black curve, right? They have nothing to do with each other. So I just want to say that they look like they're mirrors of each other, but they're not, in the sense that they're not related. So when we had this big drop here in 1987, the speed of the planets was falling. So for whatever reason, the markets don't do well when the planets are moving slowly, okay? They don't like it, especially when Mercury is stationary. Mercury is defined in astrology as information, motion, okay? So anytime you have communications or news or tickers or data that's flowing, when Mercury's at a station, for some reason, since markets are related to data and information, the markets don't like it. For whatever reason it is, they don't like it, okay? So we actually have similar Planetary Speed Index coming up in June, which I'll talk about to the subscribers. But this 1987, we didn't have the Fed in here. There was no Fed coming in. So understand that during these periods into here, that this is when you had a strong Fed. This was 2000. This was the 2000 high. This was the tech boom into here. So this is the technology boom. And so right when that planetary speed index peaked, the markets also fell with that too. You go through time, it's a consistent theme. This was the 2008. This was the financial crisis, the Lehman Brothers, Bear Stearns, all that stuff. You can see here that in October, this was the worst part of it. And this is when the planetary speed index was falling into here. And there's really no exceptions to this. And so this is why, for me, that this planetary speed index is the dominant indicator for equity markets. If you want to understand what's going on from an astrological standpoint, that's the best one. This is the flash crash. Remember that? 2010. Here's your big decline here. Notice the planetary speed index was also falling into there. So you see these over and over again with the planetary speed index. This is 2020. This is where we are now. It did occur. It occurred late, but it had been falling, and eventually it did have that first burst there. And then the second fall here coincided with that low into March. So, it still works, but we have the Fed coming in, just constantly providing the stimulus. So, like I say, it's a tug of war. And what I do here is try to help you understand how that tug of war is going to play out for the S&P. So the S&P is like its own separate animal, and that's why I have just one newsletter dedicated just to the S&P. So right now, what I'm going to do now is we're about an hour into this now. I'm going to start looking at the cat files. So this is like really important because this is a combination of many different multiple astro signals. So the cat file, what you see here is you'll see at the top, and by the way, whatever newsletter you sign up, you'll have a cat file for each symbol for the month. And it's done before the month. So this is the maximum value here. This is the minimum value here. And it oscillates back and forth. And so what we look at is for turning points in the market to buy. So this is copper, and copper has a bronze color. I put the border to match the color. So when you look at the border, you know exactly what you're looking at. And so right here, this is, I label this A, B, C, D. These are the turning points. So this is A, you would have bought here. And then right when it turns there on the 8th, this graph is labeled with the days of the month. This is when you would have sold here. And then on the 14th, you would buy. And then the next sell is on the 21st. And the reason is that this jog here occurred over the weekend. So this is Thursday, buy. Friday says sell, but that sell is on a Saturday, and then it's already going back up on Sunday, so you just stay long. Okay, so from C to D, it stays long, and then D to E, it jogs down. Okay, so, and I do all this by hand. I put all this together because the problem is that using just one software, you can't find everything. The time frames may be different. So what I do is I put all this together by hand to get the best information and combine everything. So this is really nice because you just have the one graph for the month, and it gives you the basic information. So this is the same graph here. This is copper. Now, copper was one of the best examples. They don't all look like this. There was a couple currencies that really had rougher months than this, but you can see here on A that this was the buy here. It went up until the 8th here, okay? Then it went down into the 14th here, and then it went up into the 21st. So it went up to the close here, like this, and then it went down here, and now it's long again here, okay? So all of this information occurred on from 4:30. So from April the 30th, this data was collected. In other words, it didn't see anything, like it only looked backwards to get this cycles, and this is all forward looking. So this was not like a back test where I went back and fitted the curve to what it looked at. This stuff all came out on the 30th of April. And I've been sending these charts out to people. So if you're on the mailing list, you may have seen these charts. And so this is the side by side so you can see them. So right here you can see, so A, B, C, D, E, And so here it is here, A, B, C, D, E. And so that's copper. So I just did a video also, so you can check out the video about this cat graph for copper. And so copper was in a buy on the 22nd, and now it's going up again. So this one looks pretty good. But again, this is just 1 month. You know, they don't always look this good, so I just want to emphasize that to you. This is gold. So gold really just had one big run up for the month on the cat file. So gold went like this, shot up at B on the 20th. It made a peak, and then it's just going down again. So it was a very simple chart. Okay, it can go up when it's running flat. It's not, you know, if it's in a buy, it's still in the buy here. It's still in the buy, and then there's the top there on the 20th. And if we look at the chart on gold, you can see there it is right there. So this one was it was simplistic in terms of the actual run. It just really just had that was the arc of it right there. So, but it gave you an idea of what to expect on gold. So these are the two side by side again, so you can see them. So here's gold. So here's A. So here's A. This is May the 1st. And then it went up until the 20th here. And here it is here. Okay, so I mean, more of these than not looked pretty good. Like I said, there were a couple of the cat files that looked like kind of like, like so-so. Like the Japanese yen was kind of so-so this month. Australian dollar was kind of so-so, but the euro wasn't. The euro actually looked really good. So that's good. I mean, you can't expect these to be always forecasting, but it's pretty amazing that they did as well as they did. And I think it's successful because you're combining so many different systems together, and they're kind of looking at the markets in different ways. All right, you ready for the euro? Excuse me with my coffee here. I have to keep my voice clear here. So, all right, so I handed this one out too to people. If you're on the email list, like I said, you'll be getting these. I gave them as a kind of like an introduction for next month. And you'll see these on for example, copper and gold will be on the metals newsletter. So if you get the metals newsletter, you'll get these charts ahead of time. Like you'll get them on June the 1st. So this is the euro, and the euro started out the month here going down to A. So on the 4th, it was the buy here. And then it went up to the 8th, and then went down to the 14th. And then we had that same situation again over the weekend. So Thursday, so it was buy Thursday, and then it was back up again. Okay, so this occurred over the weekend. So you just went from here to here, from C to D. And again, that's the only tricky part about reading these, is that you have to understand that over the weekend you ignore it. Okay, so if it goes into a sell and then a buy over the weekend, it just stays long. And then it went down into E like this, and now it should have a sharp rise. This is the 25th here, and it should have this sharp rise towards the end of the month. So let's just see how that looked on the price chart. So on the price chart here, you can see this is the euro. So I think I started handing this out right around into here. I was giving this out to people. But this first trade actually lost money into here. So from A to B here, you see this actually went down. This one lost money. But then this one here made money here. It was a short. And then this long did really well here. And then this went short here. It's still short. I guess the 26th it'll be. So this was a loser, this was a winner, this was a winner, this was a winner. So like I said, you can't expect it. And then this is why on the gold service, I put this into context with the Fed juice. Okay, so we put this into the context of, the Fed juice and in terms of the percentages. So, we do another layer beyond this with the gold service. But this is in the newsletter, this is what you would see. So again, putting these two side by side, you can see that, you can see that this euro, it did pretty well. I mean, like I said, other than that first trade that lost money down into here, that first trade did lose into here, and it said it was supposed to go up. But after that, it did start to follow this pretty pretty clean. So this one went to here, sorry, to here, and then down now and down. So pretty amazing that it can pick this stuff up that early in the month. It is amazing. And I think that on the first, I didn't even have it on there. There's May the 1st. Actually, this was a sell. This was a sell from here to here. Actually, I didn't even pick that up. So that was a sell there. So that would have been a winner there. So all right, so we're seeing this now on multiple symbols that this is pretty good stuff. I mean, and I didn't even put natural gas in here. Natural gas has been, it's just difficult. Natural gas is a difficult one to forecast, but with these cat files, natural gas has been doing much better. So that's another one. I didn't have time to put them all in here, but I'm just trying to give you an idea of this is what you will get with the currency newsletter. You'll get this for every symbol. And the focus on the currency and the metals newsletter is more on it's more on this. It's more focused on data than it is more so on commentary. With the S&P, because there's the Fed and all the astro, I really do more on the commentary side. These newsletters are going to be much more just data driven, where I'll have some commentary, but it's mainly just the charts and the data for you to look at. So I'm also going to give you the solar cycle for the year. So you'll get to see like where are we in the year? Like when is the euro at a high for the year? When is the euro at a low? So the cat signal is great, right? But now you'll be able to see the whole year too. So this is really exciting. I mean, this is going to be a good service. I mean, these are all going to be good. There's only so much I can put out each month, but I think for now, the currencies, the metals, and the cryptos are going to be good. I think so. All right, so let's talk about silver because silver is, this one was important because it actually turned a day early. So silver started out the month at a low here at A on the 1st, and then it went up into a buy on the 8th. So it was a buy, sorry, it went buy on the 1st, sell on the 8th, and then it came down here 13th, back up to the 22nd. Now, silver remember gold topped earlier, so silver actually went like this. It actually fell, and then it went back up, and then this was the high, and so then it's hooking back down. So I'm going to show you how that looks on the chart. And here's the chart here. So this one was pretty impressive. Now, keep in mind that the cat file here, I'll go back here for a second. This is more like an oscillator. So you can see it's just kind of like a sideways oscillator. But even when the markets are trending, you can see that it's picking these up pretty well, right? So like right here, so this was A, May the 1st, B was the 8th, C was the 13th, and then it shot up on D. Even though on the cat graph it showed it as like an oscillator, it actually shot up here and it picked that up. Now the only problem here is that it turned early. You see this right here? You see how this was the high here, but it actually turned here, and the actual real high was back here, right? So how can you deal with that? How can you like rectify the fact that it turned so early? And the way that I'm going to show you is that you can actually look at the chart in a minute, which I'll show you on the RSI. So this is the side by side here. So you can see that silver, this was A here. So here's A, okay? And then here's B, and here's B. Here's C, here's C. Now notice, since this is an oscillator, it's not going to tell you how high it's going to run up on the chart. You see that? So it went up to D, okay? But D actually made all this ground, you see, over B. But on this chart, it shows it as like an oscillator, right? So this isn't going to tell you how far necessarily it's going to run, but it will do a pretty good job in forecasting these turning points here, right? So here's D, and then E is out here, right around the 1st is the next turning point here on silver. So that's interesting because you got to put it in the context of what's happening. just because it reached this level of B doesn't mean it can't go past it, just because this is like an oscillator. So just something to focus on. Okay, so let's go. Now I want to show you the RSI here. So this is interesting here. So RSI period of 5 down here. So typically when this gets above 93 and it gets below 7, I don't like RSI too much because when markets start to trend, they get in these ranges. So for example, if there's a bull market, the RSI will never come down and see these lows too often, right? The range might be, 40% on the low side and 90% on the upside. And if it's a bear market, it might be, 50% on the upside and 10% on the low side. But there are some universal numbers here that can give us clues. And one of them is that when this RSI gets above 93% of the 5, it can tend to be reversals. And I mean major reversals. Like this can be the end of trends, right? So we see here when this bar turns red that this RSI was above 93% of the this is you can do this at home. It's a very simple RSI. RSI of 5, period, above 93, below 7%, there's a pretty good chance it's going to turn. So you can see here that this market was extremely overbought from this perspective on the 20th here. So you could have used the RSI in combination with the CAT file to say, hey, look, this is really running hot here. Maybe we should be out of this position. Maybe it's just running hot. And that's exactly what happened. It turned. And we could do this on another video just talking about this RSI, but that's important. So we can put the chart together with the CAT file. So we can put that, this is more information from the tape telling us, hey, look, this is at some type of an extreme. So I thought that was interesting to look at. All right, so those of you who are interested in Bitcoin, now we're going to look at Bitcoin, and yeah, this one's kind of crazy. Bitcoin had a lot of turning points in the month. As you can see, we went all the way to J. If there's a point here that it looks like I skipped, it's because we were over a weekend, okay? So for example, from H to I into here, the reason why it skipped over on Bitcoin was because this was a weekend. The reason it skipped over this is because this was a weekend. So it went directly from here to here and directly from here to here, okay? So how did Bitcoin do? I mean, if you want to put a CAT file to the test, this is the one to put it to the test because A, Bitcoin is new, right? Bitcoin is new, and you've got a lot of turns in here. So, the chances of this being random, and if this works on Bitcoin, it's dramatically decreased, right? Like there's just no way. If we've seen all of these start to work now, let's see how Bitcoin did. So Bitcoin is a fan favorite, as is the other cryptocurrencies. Well, here's how we did. Extremely well. Extremely well. Okay, so I'd say the best for last year. This is the Bitcoin here. So this is A here. This is your sell. This is your buy. This is your sell here. This is your buy. Now, this went all the way up. Now, this is the halving, the Bitcoin halving. You guys remember that? This is the big event that they do where they have the Bitcoins and they don't issue anymore. Look at what it did. It caught that perfectly. You see that? And look down here. You see this RSI right here? Again, same concept, RSI of 5. So you guys write this down. You can do this on any symbol. So if you're greater than 93% on an RSI of 5, or you're less than 7% on an RSI of 5, there's a good chance that it will reverse. Now, there are exceptions. There are times when this doesn't work. When you have a severely downtrending market, the RSI can stay below 7 for days. But for the most part, if you do see these extreme levels, the market tends to want to reverse off these, okay? So take a look here. So it goes down into here, and then look at F. Buys at F, okay? Sells on the 13th here, again. It goes up, and then it hooks down, so it's still another winner here, right? Then it buys on the 15th, and it sells here, okay? and then it sells on the 20th here, covers on the 25th. Okay, so that's a winner, 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 that's a winner. Okay, all of this data was collected from 4:30 in the past. Okay, so when I ran these charts, when I send this information over, I cut it off after April 30th. It didn't see anything into May. Okay, so why is Bitcoin doing so well? I can only speculate on that. The only thing I can speculate is that it's relatively new issue, and maybe the longer these things are out there, the more and more they get manipulated, and maybe it's not as manipulated now. It's definitely following the liquidity cycle, but you can see side by side that that's pretty amazing that this information came out at the beginning of the month and it was able to forecast those turns. Okay, so Bitcoin is one of the hotter ones going. Okay, they're not, like I said, there's a few that are kind of straggling along, like the yen and the Australian dollar. They were kind of they're kind of iffy, but Bitcoin has been strong on this month. So, all right, guys. So I really appreciate you guys joining me today. If you want to reach me, it's wolftraderfutures.com. And Twitter is, the free Twitter is at Wolftrader, FUTU1. And if you want to sign up, you can head over to the website and sign up there. There's a free member area, there's the newsletter, and there's the gold membership. And if you check there on June the 1st, you will see the additional newsletters. So right now, that newsletter says just newsletter, but that will be 3 different newsletters on there. So what you'll see when you go over there in June, as soon as I get these set up, you will definitely see. Okay, so you go here. So I'm just going to take you through this here. This is the shopping icon. If you want to get your T-shirt there, you can. So it will take you away from the website. But if you want to get that T-shirt, which is for the donation, you would click here. It will take you there. So you go to a new tab, and it's going to take you to the store. And the T-shirt there, the one that says "Follow the Fed," this is the one that is the charity. And you can see on this T-shirt here that you can see on the T-shirt that it says certified verified charity. It's 100%, so it's going directly there. I had to set that up with the distributor to do that. And then if you go here under pricing plans, you'll be able to see just the different plans that we have. So right now I have the gold membership. That's every single symbol you could want. That's 20 symbols, 20 cat files, Twitter all day, Fed juice all day. But the newsletter is really, I think, what most people, they want to target a specific market. So right now I have the S&P 500. It's $39 a month, and there's 7-day free trials and everything. So what you're going to see is you're going to start to see, you're going to see gold, or sorry, you're going to see metals, currencies, and cryptos. So this is you're going to see the gold, plus you're going to see 4 newsletters here. So they're going to have those CAD files that you saw, and then you can set up a free membership login if you want. When you go to the gold membership, those of you who do become gold members, you'll be able to see there's many things on this page. Okay, so if you're a gold member, it's $225 a month, but you're going to get all the newsletters included. So every newsletter, especially now, if you sign up now, you're grandfathered in. So for whatever comes in the future in terms of newsletters, it's just going to keep piling on. So if I add 15 newsletters and you're a gold member, you automatically get all those newsletters. You don't have to keep signing up for different newsletters. The reason why I made the newsletters is because some people only care about currencies, some people only care about Bitcoin, and some people only care about the S&P. On this one right here, you'll be able to, to see it all. So like there's a video channel here. So if you go here, you can see the video that comes out, and I put out videos a couple times a week. And for the gold members, I'll put out more detailed videos, and I'll put, there's a financial astrology channel, there's a trading service channel here. There's all different ways that you can look at this market and information that we give you. This is the newsletter here. You click that, and you'll be able to see, the newsletter for each month. So that's there. Lunar cycles. So all of the building blocks of the CAT file, like the lunar cycles, they're all here. So you just like, let's say you wanted to see copper, you would just be able to go there and see the lunar cycle for that. Uh, Solar cycles, 4 months, you'll see this too. So the solar cycles show you the turning points, the turning dates going out. So you get to see the turning points, and these are like the big term picture turning points. I mean, there's a lot of information here. I mean, a lot of information. So I'm really trying to give you guys a lot of tools to make the best decisions for your investing. Again, the point of this is education, to educate you on what's happening. Now, this is the one that I just added in terms of the 12 months. So this is so important because when you're looking at like let's look at the whole year. This is copper, right? So this is like for the whole year. So where are we in terms of copper on the annual cycle? Well, we're at the end of May right now, right? So we are just coming into this, but this next bottom comes out in like June the 20th on copper, and then it has a rally, right? So that's important because you might want to understand if you're doing a longer term investment, you might want to say like, where am I in this cycle? Where am I in this long term cycle? And then this is by the zodiac signs, and all this tells you is that when you're in a certain sign, what is it doing? Well, the market, copper bottoms at the end of Gemini, which is the end of June. So it just tells you by zodiac sign. So that's pretty cool too, if you want to look at that. And then I have all of them there. All of the symbols are there. And then you have the cat master here. So the cat masters, so all the different cat masters, you guys want to scroll down, it's like cat master heaven here. Okay. So if you guys want to see, here's the S&P. So here's the cat master on the S&P going up into the 28th. And I showed that on the graph, like the planetary speed index actually makes a high on the first. I think it might go past this, but this is the cat for the S&P. I mean, you name it, it's here. It's like information overload. So if you really want to see what's going on in each market, this is a really good place to come. And I think we're getting better every month, and I think these services are getting better, and you're getting, I think, a really good value here. But if you just want to look at, like, for example, if you just want to look at, like Bitcoin or something, you would get this one in the newsletter. And this is what I just showed you um, in that last when we talked about the comparison, the side by side. This is the chart that it is, and this is for May. So now I have to put all these June charts out in the next week. So I'm going to be pretty busy over the next week, but I think I have it covered, and it looks good going forward. So I think that's it. I think I'm going to conclude here. Does anybody have any questions? Does anybody want to chat or have any questions? I can take some questions now in the chat. All right. So if nobody has any questions, I'll wait to see if somebody types something. All right. So I think that's it, guys. So thank you so much for joining us, and make sure to sign up for the email list. If you have not done so, make sure you sign up for this. If you're not a newsletter member or you're not a gold member, go here on the website where it has free email list right here, and sign up there, because if you're on the free membership, you may not be on this list. So make sure you sign up on this list if you're not a member, to get updates about what's going on in the future. So I think that's it. So guys, it was a lot of fun. I know it was a little bit long. It was an hour and a half, but I had a good time. And, I hope you can see what's going on here. I think there's a lot of good tools, a lot of good information for you. So we're going to have something for everybody. And so shoot me an email if you have any questions. It's Shane@wolftraderfutures.com. And I will talk to you soon, guys. Have a great night, and peace out.